Assalamu alaikum, good afternoon, and welcome everyone to our second session this year, where we're discussing the results for our first half of 2023. As usual, if you would allow me, for new joiners, I will give a brief introduction about the company, following which our CFO, Mr. Vishal Makwana, will run you through the financial performance of DIDIC. As a brief overview of the company, as many would know, DIDIC was established as an investment holding company back in 1987. We are currently one of the largest investment holding companies in the Sultanate of Oman, with a total investment book size of 210 million riyal. Our investments are in a variety of sectors, such as banking, financial services, insurance, manufacturing, utilities, and others, almost all concentrated in Oman. Our major investments are Bank Dhofar, where DIDIC was the promoter and is currently the largest shareholder in the bank, which ranks as the second largest commercial bank in Oman, or was until very recently.
We
are also the promoter and the largest shareholder in Dhofar Insurance, the second largest insurer in the Sultanate of Oman. And we are also the largest shareholder in OIFC, the leading services company provider for billing, factoring, and payment processing in Oman. Our major shareholders include some very prominent business groups, such as Muscat Overseas Group, FinCorp Investments, Militant Trading and Contracting, in addition to a number of government pension funds, such as the Civil Service Employees Pension Fund, the Royal Oman Police, among others. Many of the shareholders we just mentioned are promoter shareholders of DIDIC and have been investors in the company since establishment. With respect to our board, we have a board of 7, chaired by Sheikh Khalid Al-Mashani, and the deputy of the board is Mr. Tariq Abdul Hafiz Al-Ajeli. The majority, or almost all, of our board members are highly experienced with directorships in very prominent companies in Oman, such as Bank Muscat, Bank Dhofar, Dhofar Insurance, among others. The key management personnel sitting around the table today include myself, Ramiz Al-Amoudi, Chief Executive Officer, Mr. Vishal Makwana, our Chief Financial Officer, and Mr. Jamal Rashid, our Company Secretary and the Compliance Officer. A very quick rundown of our investment philosophy and process. We generally look to invest in equity instruments issued by both new and existing companies. We target specific sectors that are pre-approved and agreed with the board. And we target investments that meet our vision for continuing the development of Oman. We will also consider investments outside of Oman. However, we limit such investments to an aggregate of 10% of our total investment portfolio. Our investments are generally made according to a pre-approved or pre-agreed allocation for our capital along specific sectors and geographies, and with specific risk considerations for each asset class. The way we manage our investments, we generally present our ENRC, which is our investment committee, with plans to make investments and divestments in any given time period, which are approved by the ENRC and the board. We evaluate the investments periodically and submit a quarterly report to our ENRC, and follow-up actions are taken with respect to each investment, based on the performance of the investment, the future outlook for that investment, and the risk that the investment carries. With respect to risk management, we conduct our risk analysis using a scenario analysis framework, and we allocate, or we have set risk tolerance by asset class, which is generally determined through a maximum loss on each investment's carrying value that we are willing to assume in any given period of time. Just a quick rundown of what our investment portfolio looks like. We have 3 subsidiaries: Dhofar Investment and Real Estate Investment Services, Garden Hotel, and Dhofar International Energy Services Company. The total value of those investments or those subsidiaries amount to 2.6 million riyal. We have the bulk of our investments falls under the category of associates, which includes our investments in Bank Dhofar Insurance, Financial Services, OIFC, Salala Medical, and Oman Gulf Food Company, the last two being non-quoted investments. The total value of our associates in our books amounts to 167.7 million. The market value of those investments amounts to 151. We also have a pretty sizable portfolio of marketable securities, mostly marketable, although some unquoted investments are included in that. The total value of that portfolio amounts to 25.5 million, and the major investments within it include Bank Muscat, Salala Port Services, Dhofar Tourism, and Dhofar University. With respect to fixed income, those are mostly fixed deposits, but also include a loan to one of our subsidiaries, namely mostly Garden Hotel. The value of those comes to 6.8 million riyal. If we take a look at our key investments, the first three fall within our associates, and those include Bank Dhofar, in which we hold a stake of 24.4% and carried at 136 million riyal. As many people know, Bank Dhofar is the second largest commercial bank in Oman as of Q2. It was established back in 1990 and has more than 25 years of operation. It operates a network of 70 branches, 60 conventional and 10 Islamic under Al Maysara brand. The bank has total assets of 4.6 billion riyal, shareholders' equity of close to 560 million, and the current market cap is 518 million riyal. We are also the largest shareholder in Dhofar Insurance, in which we own a stake of 38%. It's valued at 13.5 million. Dhofar Insurance is the second largest insurance company in Oman by GWP. It was established back in 1989 and as such has over 30 years of operations. It has a network of 42 branches and 7 regional offices. Its GWP for the first 6 months of the year amounted to slightly more than 45 million riyal, and it has an investment book of 59 million riyal, and its current market cap stands at 22 million. The third associate is OIFC, in which we own an ownership stake of 38% and is valued at 10.7 million riyal. OIFC is the leading company in terms of billing, collection, debt factoring, and payment processing in Oman. It's established in 1979. A pretty sizable investment book, the most important investment of which is their 15% stake in Bank Sohar. The total investment book of OIFC amounts to 123 million. The company has a book value of 34 million and a market cap of 22 million. With respect to our 3 subsidiaries, the major operating one is Garden Hotel, which owns a 3-star property branded as Garden Hotel in Likhwair with 153 keys. We also have Dhofar International Energy Services company, which is the entity that we use to invest in utilities and power and the power sector. That company owns a total of 4 investments, including DGC Dhofar Generating, Al-Dahra Generating, Shinaz Generating Company, and Dhofar Desalination. The last subsidiary we own is Dhofar Investment and Real Estate Services Company, which was a vehicle we used to make certain investments within that sector. The most important of which was Octal, which we exited in 2020. If you would allow me, I will pass on to Vishal just to run you through the financial figures.
This is the summary of the group level financials, the P&L and the balance sheet. I will just move on to the next slide where we will have the further details. Looking at the profit and loss statement at a group level, our total income dropped from 3.4 million to 770,000, mainly on account of unrealized gain or loss. So as of H1 of 2022, the unrealized gain for the period was was 1.8 million. However, for the same period during this year, it was unrealized loss of about 730,000. So that amounts to about a gap of about 2.5 million. Apart from that, the interest income was slightly lower. However, the other income was marginally higher as compared to same period last year. If you look at the share of profits of associates, it has gone up in the current year. The main associates which are contributing to the same are Bank Dhofar Insurance, where the share of profits have gone up. However, in OIFC, it was marginally lower, and Salala Medical was significantly higher for the same period during the current year. The total expenses have increased by about 16% at a group level, mainly because of incurring of the expenses pertaining to the merger with OIFC. The finance cost overall has gone up. However, the interest for the period is lower by about 500,000 as compared to the same period last year. However, as we have refinanced our entire loan during the current year, the unamortized portion of the earlier loan of about 1.3 million has been charged off in the current year as a one-time adjustment. If you look at the balance sheet size, then the investments in associates and overall equity has grown marginally over the period, mainly on account of booking of the gains of the associates during this period. The total equity has gone up by 4 million, mainly on account of the retained earnings during this period. The total debt has significantly dropped, mainly on account of about 11 million of repayment, which the parent company did in Q4 of last year. Now, moving on to some of the key highlights and metrics of our key associates. So in Bank Dhofar, their operating profit increased by about 13%, and their Islamic financing has continued to show the growth year on year, where it showed a segment profit of 5 million as compared to 4 million for the same period last year. The other income, including the commission income, has grown significantly by about 56%. The value of loss assets has increased marginally by about 10%. This shows they continue to create provisions for future. The GPL ratio is 5.86% as compared to 5.57 a year ago, and the NPL is at 2.29 as against 1.04 a year ago. One good development is that the price to book value has jumped significantly from 0.64 as of June last year to about 0.93. So this market price is now coming very close to the book value. Dhofar Insurance, their profit from operations was up about 10% during this first 6 months. And similarly, the net underwriting results were also increased by almost the same percentage. However, the net claims ratio was slightly higher, while in motor it was 102% as against 96, while the medical insurance was 68 against 53. The shareholder equity has gone up from 27 million to 32 million, partly on account of their earnings, their retained earnings, and also on account of the conversion of their convertible bonds to shares. If you look at OIFC for the first 6 months, their revenue from operations were almost constant. They in fact dropped margin by 3%, and their operating profit was down by 12%. However, the revenue on a standalone basis was constant. These are at the group level. Their net finance cost has gone up significantly by 50%, which has actually put a pressure on their profitability. And this has increased because of their increase in the borrowings. And this majorly of this borrowings was done for investment into their associates, Sohar International. If we look at the shareholders' equity and debt growth over a period, so as you can see from 2019 onwards, the shareholders' equity has grown significantly, more than 2 times. However, and on the other hand, the long-term borrowings has gone down significantly from about 115 million to about 81 million as of June. And on account of this, the debt to equity ratio over this period has dropped to 0.63 as against 2.15 in 2019.
Yes, I can run through this. Just as a conclusion of what has been presented, as you can hopefully have seen, the company's investments are all showing signs of improvement, with profits and distributions expected to continue and increase. As just post balance sheet information, the previous transaction that was announced by DIDIC of the sale of Oman Gulf Food Company to Dhofar Food and Investment through a private placement process was completed in the last week of July. So as it stands, DIDIC is currently owns 26.27% in Dhofar Food and Investment, which is classified as an associate for us. We can also confirm that our borrowings are manageable and are we are well positioned to service all of our commitments to lenders. We continue obviously to look at a number of initiatives moving forward to both fast track our growth and to continue the shareholder value addition. And we will keep everyone posted with any such developments at the appropriate time in the future. This concludes our presentation for today. I would like to thank everyone for their patience, and we are ready to accept any questions or inquiries from whoever is attending. No question.
Good afternoon, gentlemen. This is Abbas Muslimi from Vision Capital. Thank you for the presentation. At the outset, let me just thank you guys for, because the quality of presentation and the quality of disclosure is probably one of the best I have seen for any investment holding company in the country for many years. And I've seen a concerted effort for this to happen. I see how transparent you guys are. And, let me just congratulate you guys and just thank you guys in a way to sort of put it out there. So it's extremely easy to analyze your company, extremely easy to understand it. And, I really appreciate what you guys have done over the last couple of quarters. So I really appreciate it. Okay,
thank you.
The first one is the elephant in the room, the OIFC transaction. I know it's sub judice, and a few shareholders have actually gone ahead and spoken to it's in the court of law. Now let me ask you a clarification. Normally in a transaction like this, because in the last call I was on the call when you explained the valuation methodology of OIFC and the valuation methodology of DIDIC. As an analyst, I did not take too much exception with the valuation methodology of OIFC. In my opinion, what you guys did was reasonable, was fair, but that's just my personal opinion. The issue for OIFC shareholders came where there was no cash option offered to them. So let's say you value them at 25 odd million, 0.9 price to book, but when they don't have the cash option, they are at the mercy of what you value DIDIC in a 100% swap ratio transaction. And you know what's happening. They obviously, because DIDIC was trading at 140, 150 paisa right now, there was a book value of 320. You discounted yourself by 10. But at the same time, there was an implicit 140 going to 290 and 120 paisa coming down to 110. So that's when they lost money, because they didn't have the option of availing a cash payout at the valuation that you gave the company. And the courts will decide which way they want to take this transaction. But can I ask you, from a corporate governance point of view, when a transaction like this is put up to voting, does it make sense for a holder that owns 38% of the share capital of that very entity to actually vote in the merger? I mean, because I like what you're doing with the company. I like how honest and how transparent you've been. I thought, let me ask you this question and hear your views on it, sir.
Well, Abbas, I'll be honest with you. Obviously, I'm not a lawyer, nor am I a legislator by any way. I mean, when we approached that, and there, as you rightly said, it's currently before a court of law, and we're limited or at least constrained in how much we can discuss this. But from a regulatory point of view, we were assured by all regulators and involved experts in this that we are entitled to a vote, and so we proceeded along those lines. So that's really all I can say about it. It's at the end of the day, whatever the local regulations stipulate is what you follow, and we feel that we have followed that to the letter. But other than that, there's really not much I can say about the status of that transaction for the time being.
Okay, and have you heard one way or the other when will you hear about if it goes through or not? Because that's a bit of like a like a purgatory right now that's going on for at least.
I agree with that characterization, Abbas. As far as we know, and I'm once again, I would like to highlight that we are obviously not a party to the legal action taking place. DIDIC is not is not represented in that court of law for the time being, and we're not sure if we need to be or will be. But as it stands, what we know is that the case is scheduled to be heard in mid-November, and as such, we don't know if anything could happen before then. But should any developments happen, we will certainly make the appropriate announcement at the right time. But as it stands, all we know is that there's a case scheduled to be heard in mid-November.
Okay, and the last question, and you can refuse to answer it, there's no thinking at DIDIC's point that you come up with another offer with a possible cash option on the table for the aggrieved shareholders?
Not for the time being, no, not at all.
Okay, thank you for that. I mean, again, I appreciate your transparency and very clarity on my questions. So the second question I had is I was going through your notes and I noticed that you refinanced approximately 82 million riyal in debt at the end of June. Now I was just running a sort of annual payment sort of numbers, because you mentioned that it's a 6.25% yielding loan, and you need to sort of repay this loan by June 34. So which means that your annual outflow is going to be a 10 million Omani Riyal approximately if the loan value has to go to zero. Just a basic number assumption that I built.
Yeah, no, well, there's two things, Abbas, here. One is the loan value does not actually go down to zero over the tenure of the loan. There's a bullet at the end, which would either be refinanced or paid. I mean, obviously, there's a long way to go before we reach that. And then there's a pre-agreed repayment schedule, and so the payments do not occur in a straight line. It has, the repayment was actually agreed with the lenders in accordance with our long-term cash flow projections. So as it stands, we do not see any challenges in terms of meeting those commitments. But having said that, the purpose of the refinancing was not a simple gain in terms of saving and interest. There are other covenants that come with the new refinance package that are a significant improvement over the previous structure that we had. And that gives us significant flexibility in how we can restructure our portfolio moving forward.
So thank you for that, because I mean, it wasn't very clear to me when I sort of read this one line, because it implied that you're going to repay the loan by June 34th. So I think if there was a clarity provided there, it'll just help all investors, in my opinion.
I think what we'll do is hopefully the next round in the notes will provide a little more explanation on the structure of that, just to give analysts and shareholders a little more clarity on what's been put in place.
Much appreciated, sir. So now that I have you on the call, let me ask you, so when you're looking at this loan being restructured or refinanced, what sort of annual outflow are you looking at? And I'm trying to tie it to the cash flow that you generate. I mean, we know it's an investment holding company. The only sort of real cash flow you make is from the dividend income of both your associates and your investment holdings that you have. We have some sort of an idea what that thanks to your disclosure, again, we have an idea about what that cash flow generation ability of the company is. I'm just trying to tie this to the last conversation we had when, you said that, hey, I'm very aware of the shareholders' requirement. I want to start repaying dividends. I'm going to look at, and you've executed at least on the loan side of things, right? So I'm just trying to sort of reflect on this, that the OIFC transaction does not go through. So because there was a lot of cash coming in from that transaction, the way I analyzed it from DIDIC's perspective. So let's not talk about that. But that was a really beneficial transaction to you from a cash flow perspective. But here, when I look at your investment book, your only cash that you make is on a dividend income basis, unless you start disposing securities in the market. That's going to be another question of mine. Any plans to dispose? But the first part of the question is just based on your operating cash flow that you get from dividends and the new loan profile, what sort of cash flows will be left for distribution? I know dividends is going to be a board decision, but just from a management point of view, what sort of cash flows will you be left out with?
Well, I think, given that we're talking about a long-term cash flow projection, I think it'll be difficult to actually nail down exactly in terms of quantification, but I can just comment in generally speaking in terms of the strategy of us as a holding company. Obviously, naturally, when you're a holding company, you invest in certain investments and you're looking at a combination of return that comes both from the dividend side and the capital appreciation side. So strategically speaking, the disposal of assets is a natural part of the business. It should not certainly be taken as a negative indication. At the end of the day, as investors, we invest with a certain, and we always discuss exit options whenever we make an investment with that in view. So, for example, last year when we paid down 11 million in debt, a good chunk of that was financed through asset disposals. I mean, naturally, that's one way to go about it. And we will continue an asset sale program moving ahead. However, it is not a program of us having to sell an asset under duress or go through a fire sale process because our liquidity is not there. It's a program sale with specific assets highlighted for disposal according to a schedule that we continuously work with. That schedule is shared with our board, obviously shared with our lenders, and we are all aware of which assets need to be sold at which point of time to both fund the repayments to lenders and to fund dividends down the line. Now, as Vishal indicated in the last slide of the presentation, our current debt to equity ratio is lower than 1. We have a significant amount of surplus on the asset side that would allow us to meet those commitments and resume payments to shareholders. So as it stands, I feel that our strategy is bearing fruit, and our lenders have agreed to us in terms of the reasonableness of the business plan moving forward. And if anything were to slip here or there, I think the market will find out about it very quickly. But we do not foresee any such complications at the current time.
Okay, and could you comment, because eventually we'll find out in terms of what the annual outgoing is for the next couple of years in terms of interest plus debt repayment?
Well, I mean, for the next couple of years, the outgoing is only the interest, really, because we do have a moratorium. There is next year we do have a debt repayment. That's about 2 million, is it? Around 3, yeah. So other than the interest, we have a scheduled repayment of 3 million in 2024. But given the nature of the agreement of the refinancing, that payment could be made in 2025 should we elect not to do that in 2024. Obviously, it will cost us more in interest if we don't pay down the debt. But that is one benefit of the inbuilt flexibility I was talking about, in that we do actually have a level of flexibility on when those payments are to be made. And so there's always a cost-benefit analysis that we undertake internally before making that decision. Noting that even in the previous agreement, we had a similar structure, and we did have to do that same kind of cost-benefit analysis. It's just the way the schedule of the payments when they were lumping together is a little more spread out in the new agreement than in the previous one.
Understood. That's quite helpful. And you know, when I spoke to you on the last call, again, you were I think my analyst raised this question, and you admitted that, hey, while I want to sell some of my assets, it's not a fire sale by any means. I also have some illiquid assets that it's not very easy to sell. So I'm just sort of circling back to that discussion that the non-core assets, I exclude the Ghafar Bank and I exclude the DIDIC and OIFC. I mean, I see those assets now in terms of just improving the performance before you can sell it. Do you feel as a holding company, you have a voice on the board, but as CEO, is there like a concerted effort to sort of try and fix companies that are not performing? How actively involved are you in portfolio companies that, because that are not really up in terms of performance metrics that you have?
That is a fair and excellent question, Abbas. Obviously, our level of influence is directly proportionate to our ownership held in any of these entities. So in some of them, we have a significant voice and influence. In others, we don't. But having said that, if you're talking about an associate or a company where we have board representation, whether directly or indirectly, we do play a pretty active role. But whether us as executives or our directors as individuals serving on these boards. And whenever we feel there is room for improvement, we are very open and proactive in terms of letting our views be heard by the other management teams and boards. So by and large, I can say that for investments in which we have a significant ownership stake, we do exert a certain level of influence. But investments in which we are a minority and they're quoted on the MSX, obviously we remain a minority shareholder just like anyone else. So it's a mixed bag. In some you can fix, in some you can't. So just as an example, obviously we just discussed our movement in our current acquisition of a significant stake in DFI. DFI, as many people would know, is a company undergoing turbulent times in need of certain changes, and in that company we are looking to play a very active role in terms of turning it around.
Understood. And when you look at, I mean, the company has been through a sort of challenging curve. You refinance these loans, you're saving some money on the interest cost. So now when you look at your portfolio, and you said that, you're not really leveraged to the hilt, you still have some room. So what's your investment strategy for new businesses? Like, how much will the bank support you in possibly extending leverage, if that's a possibility? And what sort of strategy do you have in terms of acquiring new businesses or new investment positions? I mean, I just wanted to understand from that perspective, because yes, sir.
As you rightly pointed out, we do have room to borrow more money should we need to, and that would be discussed on a case-by-case basis with individual lenders. But that will only really materialize if we're talking about some greenfield project we're looking again into. I think our priority right now is to try to reach that 10% offshore investment target, bringing in some diversification into our investment book, and that's something that we're looking at very seriously right now. And we don't feel that we will need any additional leverage to do that. It's more a matter of rebalancing the portfolio by exiting some of the investments we have locally when the time is right to do that, and diverting those funds to international investments, out of the MENA region by and large.
Okay, that's helpful. And when it comes to the local investment that you are open to exiting, it's still not going to be easy to exit in the next year, right? I mean, this is, I think, what I gathered from your last conversation.
It depends on the investment. Some investments are easier to sell than others, obviously. But as I said, I mean, we work out an asset disposal plan well in advance, and we get into discussions revolving around multiple exits at any given point of time. Knowing that maybe 2 out of 3 will not go through, but we're usually targeting just the one. So yes, you're right. I mean, the nature of the market is the nature of the market. Of course, we still maintain hope that with the new regulations coming in for market makers and liquidity providers, that at least some of the investments will become a little more liquid, allowing us a more ready exit. But that's time.
It's so interesting that you raised that point, because one thing when I pick up DIDIC shares is that, it's not been the most liquid share in the market, that, you can't really force your current shareholders to sort of do anything with the share. I mean, they're happy to hold it, I'm sure. So when it comes to your perspective, how do you see, the importance of sort of shareholder, engagement when it comes to like the MSX or, the liquidity enhancement? As CEO of this company, which sort of direction are you thinking? I mean, are you indifferent to stock prices simply because the majority of your board is very happy to hold them, and, price discovery is not so important in DIDIC's context compared to the rest of the boys? I mean, I'm just trying to understand your philosophy on share prices of DIDIC in the MSX.
I don't think that would be a fair statement, Abbas. Obviously, even as CEO, I am concerned with the share price, and noting that my ability to affect that is limited, as everybody knows. But no, I mean, we would obviously prefer that our share become more liquid than it is. Obviously, we're aware of some of the key shareholders, but we don't know all of the shareholders' feelings vis-a-vis that. And so we view the introduction of a liquidity provider or money or market makers in the market as a very favorable development for us and others. And the reality is we've already engaged with one of the companies, at least. We're looking to engage with the other that have been licensed to play that role, with a holistic view of both our shares and the portfolio at large, to see where value could be brought to shareholders by increasing the turnover of stocks on the market. I think that's still something that is required. At the end of the day, I think the more liquid our share is, the better the price discovery and the more fairly valued it is. I think everybody can agree that the market value of our share, and indeed the shares of many other companies, does not reflect their true intrinsic value simply as a result of a lack of trades. So I still think that the share price is an important indicator, and it is something that I am concerned with.
Thank you. I appreciate that comment. And the last question from me is, Bank Dhofar was in the news recently with the merger of RD Bank. Now that sort of, and I'm not going to talk to specifics of Bank Dhofar, But, it sort of made a lot of us go back and, the reason the merger, sort of the acquisition proposal was rejected was the Oman banking law with CBO. I think when we all sort of dive deep in that banking law, it seems that one group cannot own more than 10% equity in two separate banks. Now, that brings me to the question, when I look at you and your proposed merger with OIFC, you already own a associate stake in Bank Dhofar. You will own a above 10% stake in the merged entity, which is Sohar. Have you heard back from CBO with an exemption to this, or what sort of, because you will be the owner of that stake, right? So I'm just wondering what's your view on this, sir?
I mean, I'll just give you one. It's still obviously something yet to be decided once hopefully the merger starts moving ahead. But our view on this is that we believe that there are precedents in the market where certain groups have been allowed to own important or significant stakes in multiple banks. And we feel that we have a case to make to allow the merger to go through. But that's a bridge that we haven't even reached yet, to be honest with you, Abbas. So it is an important, yes, you're right, it's an important element of regulation that needs to be considered. But it's not a point that we've reached just yet.
Great. Thank you for your answers, and I appreciate your time and all the very best to you. And I look forward to coming and meeting with you sometime in person.
It'll be my pleasure, Abbas. Thank you very much. I appreciate how active you are on these discussions, and I enjoy these discussions. Yeah.
Thank you. I appreciate it. I mean, these discussions are what you and me both bring to the table, right? So, I mean, having a CEO like you on the other side, it really helps things. So I appreciate that. Thank you.
Highly. Thank you. Thank you very much, Abbas. Any more questions? أي أسئلة تانية يا جماعة? We are ready. We're happy to answer. Okay, I guess not. In that case, I would like to thank everyone for joining us on this call. And I look forward to seeing you again soon. Good afternoon. Good afternoon.